Hey everybody, it's Chris with Life 180, and I am here today with Cole from Ascendant Financial. He is up in Canada. He's an amazing, amazing guy. We've gotten to know each other over the past, I don't know, several months, and he's got a lot of awesome projects going on. I think one of the things that kind of struck me with Cole out of the gate was his entrepreneurial spirit, right? Like it's just his desire to go out and serve kind of like the free market, and which as a Canadian, for me, from my experience, is a little bit rare. No offense to like Canadians, but like it's typically a little bit of a different mindset. So, he's got that capitalistic heart, which for me is an amazing thing. And, so he's taken that and his entrepreneurial experiences and he's brought it into the financial space, and he's become a part of the Nelson Nash Institute. He's an IBC practitioner. He's just a wealth of knowledge. And so as I am starting to try to build more and more content to serve Canadians, it seemed like there was no better person who, would be able to get all the answers needed to be able to serve Canadians in this space than Cole. So here we go. Cole, welcome. Thanks for being here, man.
Thanks, Chris. You're too kind.
Oh,
and yeah, what you said about Canadians is kind of true.
Well, I mean, I say it in fun, but hey, it is. But Cole, I got to say, I'm excited to have you here. I'm excited to have this just kind of be like a flowing conversation, because I think I don't want it to be like structured and formatted, simply because I feel like you and I have talked a lot about this, and we kind of both see the world from the same lens. And so I think there's going to be a lot more value with us just kind of shooting from the hip and having a conversation around this, rather than trying to like structure it out ABC style. You know what I mean?
Love it.
Cool. So in your experience, because you know more about this than I do, from an IBC perspective in Canada, what do you think? Let's just start with, what are the fundamental differences between the United States and Canada when it comes to IBC, for somebody who is in Canada who goes, ooh, that sounds like a great concept, but why can't I find any information on this in Canada?
Right. So there's actually one other good source of information on IBC in Canada, and that's actually where my license is at Ascendant Financial. Those guys are doing a fantastic job with growing it. That's not a plug. I mean, you asked the question, where is the content? I mean, that's where the Canadian content is, and now there's Canadian content here. And so that's the one thing. The biggest challenge that we get as IBC practitioners, the infinite banking concept, becoming your own banker, the biggest challenge that we have as Canadian IBC practitioners is that the vast majority of Canadians are watching American content. And they're sitting down with us, and we have to go through this almost like this like vetting, or this kind of this stripping away of what they may or may not know about how on the product side it works, because there's two sides to the infinite banking concept. There's the product side, and then there's the concept side. The concept side is similar. Nelson Nash wrote the book, Becoming Your Own Banker. It applies conceptually to Canada, the US. It's just the product side of it is considerably different.
Okay. So what does that look like? I mean, because you and I have talked a little bit, fair amount, about the difference in products, like how like the United States whole life companies typically give a little bit more flexibility as far as how the base premium works, how the paid up additions work, how to build more cash value in the policy, how to have early liquidity of cash in a policy. How does that impact the long-term internal rate of return in a policy? Like all these different things, the give and take. So what do you think? Are you kind of under the mindset that there is an optimized way to do this for Canadians?
Yeah, the optimized way is doing it. I mean, the unoptimized way is not doing it. Yeah. I mean, any version of infinite banking. I mean, and again, get a credible advisor, as you know. I mean, someone that understands the conceptual side, the thinking side, the problem, and why is infinite banking so popular? Well, it's people that are buying into the infinite banking concept, or people that understand what the problem, like the big picture problem actually is.
Yeah.
And then comes obviously the product, which is is whole life insurance, right? There's no secret about that. Now that's the recipe. It's identify the problem, apply the infinite banking concept, and then use whole life insurance to solve the problem with the concept.
Yeah.
But then, you get a lot of people, a lot of advisors that have their own spin on it, that try and fix what isn't broken. And they start using other permanent life products to solve the problem. And then that's where problems don't get solved. They get worse. Very
amplified. Yeah.
Very, very truthfully.
Yeah, no, that's true. So, I've done a lot of videos on that topic.
Can of worms.
Yeah. I don't know if I want to go down that rabbit hole.
No, let's not do that right yet.
That'll be a 2-hour conversation. So before we started recording, you were talking about like to get into the Nash Institute, it was basically like getting a degree in Austrian economics, right? So I love that, because you also just talked about, whole life is really just the product that's used to solve a problem. And the problem is typically identified with, or the problem is typically associated with people who identify that, hey, the world that we're living in right now is having a lot of challenges, right? Mm-hmm. And that, I'm trying to think of how to say this succinctly, but like the bottom line is anybody who understands that, this world of Keynesian economics that we live in, and this world of debt and spending, especially with COVID and the irresponsible nature in which governments are handling, especially the United States government, it's just deplorable, in my opinion, how we're like creating just $1.9 trillion bills out of thin air, and $1 trillion of it is just waste, mm-hmm. Like it's deplorable. And so at some point in time, the reality is you have to pay the piper. Like you can't get away with doing that. And we've just been kicking the can down the road for so long. And I think what I love, and I'd love to hear a little bit about like your perspective on this, but what I love about this and why I do this and why I coach all my entrepreneurial clients for it and why I'm such a big believer in this is the fact that, listen, like we are in this environment where, we don't know what's going to be happening. And what really draws me to this strategy is that it is the true and asset. It is a place where no matter what happens in the world, because we don't know what's going to happen. We don't know the timing of it. We don't know how extreme it may swing one direction or the other, right? And so what I love about this is it is the true and asset when you do a whole life policy properly and you follow this concept. And when, if the economy goes well, you're going to be all set, right? Like you're going to have, you're going to have like liquidity, use and control of your money. The returns are going to be decent, like it's going to be fine. It's going to be a bank account on steroids. It's going to be phenomenal. And you can use it in so many different ways. If the economy goes really poorly and everything, you have liquidity of that money and you can get it into assets, that are going to protect you. And so there's not another financial strategy in the world. If you align with kind of the direction of the world. I actually just did a video a couple of days ago, and if you haven't seen it yet, go back and watch it after this video. It's how, I'm trying to think what the title of it was, but the concept of it was how out of alignment people's values are with their investing strategy, right? Yeah, it was the one on 401ks, why the government wants you to invest in 401ks, right? It's like that so many people are so most of the people I think that are attracted to the IBC strategy or the and asset, whatever you want to call it, they're conservative leaning people, right? Like because they naturally have that. Yet it's interesting to me that so many conservative leaning people naturally just put their money in 401ks and IRAs and deferred, programs where they don't have to pay taxes until later, and they give the government control of their money essentially, when it's like they're on social media beating their drum about how much they hate the government, how little they trust the government and all that stuff, yet they're putting their entire financial future in the hands of the government, right? Like, so to me, that's why I love this, is showing people like kind of lifting the veil and being like, hey, dummy, like, look, like, you know what I mean? Like, this is you, what are you doing? You know what I mean? And then showing another alternative, because I think a lot of people just do what they do because they don't know of an alternative. And I love showing people the alternative. How about you?
I get all the time, it's too good to be true. Why are more people not doing this? Why haven't I heard about this before? Well, I mean, the answer, I get asked that question so often and so regularly by Canadians, by Americans. And the answers are just really simple. I mean, if you really think about it, who are the ones with the big marketing budgets, and who are the ones trying to get your capital?
Yeah.
Because really, and you brought this up, and which I think is so brilliant, is that the infinite banking concept is the solution to the problem is really simple. The problem is banking. Period.
Yeah.
The problem is banking doesn't mean in Canada CIBC, TD, RBC, Manulife, right? We're not talking about banks. We're talking about banking money. We're talking about pooling capital. Where do you want your capital? Where do you want your money to reside? It has to reside somewhere. So where do you want it to reside? This is a bank of capital. So banking is the problem. Where you hold your capital really is the problem. You talked about 401 IRAs, Roth IRAs, 401ks in Canada. Our mechanisms around those types of things are, you have 529s in the US. Our version of a 529 is an RESP. We have RRSPs, and we have TFSAs in Canada. And we have regular bank checking accounts and savings accounts just like you do, and then self-directed funds as well, like the Quest Trades of the world, or what have you, these self-directed stock investments. So what do I think about all of that? Well, I think you're right. I think you're 100% right. The average Canadian is, I think it's 46%. CBC, our main news outlet, has a stat. If you Google it, 46% of Canadians are $200 away or less from insolvency. So if we're told to bank or pool capital in a RRSP or an RESP for your children moving forward, or a home. I mean, a home is a great investment, right? That's a great place to bank your capital. Okay, so if all of these things, this is,
by the way, he's sarcastic.
Right? Yes, I may be a little bit sarcastic.
Everybody watching at home.
Yeah. You'll have to edit in some wicked like sarcasm kind of emoji. So the question really is that if 46% of Canadians are $200 away or less from insolvency, and we're told homes, registered savings and retirement strategies, it would suggest that some of and this is generational, it would suggest that maybe these strategies might not be working out as well as we thought. We're swimming in consumer debt. So you might think that some of these strategies, people's credit card balance is higher than their savings balance in their registered retirement. This is why 46% of Canadians are. So, I mean, there's the problem, right? So the banking is the solution. So what do you want your bank to look like? Well, Canadians they have options. And then you get back to the same questions, same options as Americans have. There's a different place to bank. The bank can be more of a transactional. We're not talking about cutting these institutions out of your life entirely, but they can be more of a transactional type of a relationship, less of a banking relationship, more of a transactional relationship. Yeah. So what do I think? I think you're 100% right. And I think that we suffer in Canada from the same problems that you do in the States. And whether if it's a Keynesian approach, which we also, and you could argue that we're maybe more Keynesian than you are.
Oh, for sure.
In many ways, because of the social structure of our country. And, if we talk about the Austrian approach to it, and just to kind of recap for, your viewers, an Austrian economic perspective on, say, like a bailout like we had in 2008, or when these companies were going down, what happened is the government stepped in and created a massive amount of stimulus. Actually, Ford Motor Company was the only one that didn't take it, which was actually, very interesting. And good for them. And the reason is because they have they had a lot of whole life insurance. That's how they actually got through that economic crisis, and they didn't need to take the stimulus money and the bailout money because they actually had the asset of whole life insurance. So that's another story.
Yeah.
But the crux of the whole thing is that, the life insurance as an asset class is very, very strong and can help a lot of people out of a lot of bad situations, both Canadian and American.
Yeah. I mean, I would argue like the only thing that the United States has going for it over anybody else is we happen to be the world's reserve currency, right? Like, and so, the rest of the world just finances our stupidity, essentially. It really is what it is. Like, and from that perspective, like, you and I could sit up here all day and beat our drum about the importance of Austrian economics and how much better the world would be if we just followed that theory versus Keynesian economics. But the reality is we live in a world of Keynesian economics. And so, I'm not a big believer. Like, I'm not going to sit here and kick and scream and cry like a baby about it. I'm just going to say, okay, what do I have to do to position myself for the best outcome in any environment? And I think eventually Keynesian economics, just like socialism, it never works. Like, you know what I mean? It's always going to fail eventually, because eventually you just run out of money, and like you run out of time, and you become over leveraged and over indebted, and debt ends up crushing society. I mean, we're 28, almost 29 trillion in debt in the United States. Everybody talks about all time. I don't know. What is the debt in Canada right now?
Well, that's actually a really good question. I actually don't know what the debt in Canada is. It's actually not what your debt is.
It's not even close. And it shouldn't be, because you guys have a fraction of the population, first of all. So a fraction of the infrastructure, you have a fraction of the need, right? Like, so
we have basically the same population of California.
Yeah. So if you had a $3 trillion debt, that'd be equivalent to what we have at 30 trillion, because you have about a tenth of the population overall.
Right.
So like, if all things apples to apples, like that's something to take into consideration. But like, the bottom line for me is, at some point in time, this is all going to kind of come to a head. And I just want to make sure that I'm protected, and insulated. That's why I believe so much in the fact that, like, listen, whole life insurance, use whole life insurance, take loans against it, buy hard assets like real estate that cash flow. Because in any environment, no matter what happens, if you own the properties outright, like, you're protected. You know what I mean? Because you own that real estate. There's always going to be people that need to live somewhere. We don't know how the world's going to do with gold or silver. I like those things. I'm not saying don't buy gold and silver. I think everybody should have a little of it, right? Mm-hmm. Nobody knows what's going to happen with crypto. Nobody's going to know what happens with all these other assets, the value of the dollar. We live, like, because of Keynesian economics, we live in this space where, everybody's so worried about the devaluation of the dollar. And I would argue that I'm not worried about the devaluation of the dollar, actually, ironically, until it's a complete implosion of the financial system, as we know it, which I think is a very viable, possibility. But I think, like, when you look at currencies, you have to look at the dollar isn't pegged to gold anymore. Everybody talks about inflation of the US dollar, the Canadian dollar, and specifically the US dollar, because all the money we're printing. And the reality is, that's not the issue. Like, the dollar doesn't inflate based on gold anymore. That's not how the dollar is valued. In Keynesian economic theory, the dollar is worth what it's worth compared to other currencies, right? So if we print $2 trillion and then Canada prints $200 billion, a tenth of the amount, and they have a tenth of the money, the circulation of money and supply, and compared to America, well, inflation is going to be about the same for each. So the value of the dollar in comparison to the Canadian dollar doesn't really change. You know what I mean? Like, that goes the same for the pound, the euro, the yen, the won, the whatever, all the way across the world. That principle exists, and it's like, so we have to be thinking about, like, the concept of inflation and the value of the dollar differently.
I just found a debtclock.ca.
Oh, nice.
It's a ticker. Like, it's actually, ticking away as we speak. So you'll laugh at this. So
have you seen the US one?
No, did it break? It would break my phone probably.
It would. It's disgusting.
Yeah. So we're at 1,123,489,000,000 and about 100,000.
That's funny.
So 1.1 trillion.
That's funny.
Versus your 30 trillion, was it?
That's pretty funny, man.
So I think one of the questions that you originally asked that I really liked about the difference between IBC Canada and IBC USA is on the product side of
I just had to show
that may just crash your entire YouTube channel may just crash because of that.
Down. That's the US debt right there. You can see everything. It's just
it's like almost $30 trillion.
Yeah. So fun stuff.
So if we were running an actual, and it's funny, we're getting into, like, we're supposed to be talking about, Canadian
Yeah, I
versus
know.
American IBC. And but the thing about Austrian economics, and so a lot of people would suggest that the infinite banking concept is in fact Austrian economics in action, in the sense that it's truly capitalistic, in the sense that it's a fair, even playing field for people to get by. Very small government, low intervention, and and good ideas will prevail. And I think that's and it really puts the entrepreneur first. And no different in Canada than is in the US, that the entrepreneur is the heartbeat, it's the pulse of any economy. The small business owner, the medium-sized business owner, the enterprise level business owners. These are the people that need the help, and they're the ones that really need that impetus and that the affection of community. And so often what happens to communities, especially on social media, they end up looking at business owners and kind of saying a lot about them online, or chirping, where we should be celebrating these people that are out there taking risks. And what the infinite banking concept, what it can do for Canadian business owners, is it can really put them in a position to succeed. Everybody loves a winner, especially Americans. They really love a winner. They also like a loser too, right? They like an honest loser. A loser can say, exactly. Hey, I failed, and then let's be enthusiastic and get on to the next. But that's the one thing that we see, that the people in Canada, when it comes to the infinite banking concept, that get it first are the ones that have the most to lose. I could spend an hour explaining the infinite banking concept to just a regular, average, kind of middle income type Canadian. At the end of the hour, they may or may not get it, right? They may suffer from different kind of human problems, as blockages, fear. It's too good to be true. Why haven't I heard this before? I can't change. I can't be courageous and think that it is possible. Whereas when you're talking to a business owner, I could be 2 minutes into the conversation and a business owner already knows the problem, because the business owner in Canada is day to day suffering from the challenges that the infinite banking concept solves. It's very, very real.
Yeah.
And that's really the people that we're really trying to celebrate. We would like it if more just Canadians kind of got it, but because of channels like yours, it's starting to happen.
Yeah, no, I love it. And yeah, I know we initially started off, this is going to be all about IBC Canada, and then we got onto the Austrian economics and Keynesian, but here's the reality, is that it plays such a fundamental component to
it's the foundation of
all of this. Yeah,
really.
It's like, if you don't believe in Austrian economics, you're probably not going to believe in the infinite banking concept. You're probably not going to align with it. It could still help you. You could still use it in a way in your life, but you're not going to fully leverage its potential to impact your life, right?
Yeah.
Like, that's what it comes down to. And so I guess that's kind of why we went there, if everybody is, kind of wondering, what are these crazy people talking about? But so let's get into some technical stuff to give some people some really fun value, right? Let's talk about, so infinite banking, I'll just use it at its simplest kind of explanation. It's a whole life policy that's maximum funded, structured properly, and I'll let you get into what that looks like in Canada. But ultimately, then you're leveraging that as a banking alternative, and you're leveraging the asset in there to enhance other areas of your life, right? That's really what it comes down to. And you're using that as a system to enhance your wealth potential, essentially. And so can you explain to me the way that policies work in Canada? Because I'm sure people have looked and seen all the stuff on how it works in the United States. I've got tons of content on that. If you want to see that, go check it out. But for Canada, talk to me about that.
Yeah, sure. So, it's actually not a lot different. We take advantage of paid up additions, just like you do in Canada. So getting into some kind of just like you do in the US. We use whole life insurance, and we max fund the cash value of the life insurance. We're creating a living benefit out of a product historically that's been tied to legacy or death benefit. So essentially, the mechanism of kind of how it works very tangibly is that the bank of your life is now transactional. The capital is banked or pooled now in a life insurance contract. You leverage out of that life insurance contract very easily. It's just an email away, or it's a one-page document that you fill out and email or fax to your life insurance company. You ask for your money. They don't ask any questions. It's a unilateral contract. There's no credit checks. There's no scrutiny. There's no inquiry in any way. They send you your money to your bank account. And then once it's in your bank account, your traditional bank account, your transaction bank account, you then take that money and do what you will with it. Live your life, pay your cell phone bill, buy your groceries. You can use it, as you pointed out, as an and asset. That's the ultimate way in how to use it. Use it for further investments. Now what you're really doing is you're putting your money to work. You're using $1, in this case, 2 times. You have the money borrowed out of your insurance contract while it's still being treated with the 8th or maybe the 9th, and let's call it the 10th wonder of the world. It's called compounded interest. So, compounded interest is one of those things that has a kind of a three-way relationship to a lot of people. It's either working against you, it's either working for you, or you're losing out on the opportunity to have it work for you. So that's called opportunity cost. And no different in Canada as in the United States. This is the thing that the infinite banking concept solves, is really ultimately for the entrepreneur and for the average person, even for the child. Life insurance, infinite banking on kids is the most powerful thing you could do, period. It solves opportunity cost. Opportunity cost is one of those things where for most people, it fell out of the sky and hit them on the head. They wouldn't even recognize it. They hear it day to day conversationally. Like some of your listeners are probably hearing us talk about opportunity cost, but really go out and grab it and feel it and touch it and actually kind of define it in your life. I promise you it's happening, but how do you get rid of it? Well, it's really what the infinite banking concept does. So kind of to answer your question about the product side of things, obviously a mutual carrier, right? That's a key component to what it is we do. There's this distinct advantages to the mutual carriers. And when we get into like the real, the product design, like the real kind of the gory details of, the life insurance contractual kind of product development side of things, there are distinctive differences, between Canada and the United States. And a lot of it really kind of comes down to tax. So without me kind of, getting into a whole digression about the tax differences on policy design in Canada, like adjusted cost basis and kind of various things, but that's really the big difference. So when viewers are looking at American content versus Canadian content, a lot of the differences are how the individual insurance carriers are designing their policy illustrations or their available cash values. A lot of it has to do with the difference in tax for the most part.
Okay. So are you able to create a whole life policy and flexibly structure it so you have, a 60-40 policy or a 70-30 or an 80-20 or even a 90-10? Because we talk a lot about that on our channel. Is like, I'm a big believer, I should say, that there's not one right way to do it. You really have to look at somebody's circumstances and what their objectives are, and then find the design that fits them, because there's a cost to every decision. If you decide a 90-10 policy is right for you, that's going to give you more liquidity up front because it's 90% paid up additions essentially and 10% base premium. So it reduces your insurance charges is what it looks like. But there are other things you have to do inside of the policy to make that pull together without mecking the contract in the United States. So there's all sorts of things, like you have to get more insurance through term riders to pull that off. Yes, it gives you more liquidity of the initial money that you put in, but it really does impact in a negative way the long-term internal return or internal rate of return in the policy. And it makes it so you have to, and I think one of the reasons that happens is because you have to get so much more insurance inside of the term rider. And so then the other negative part about that is that you have so much insurance that 7 years down the road, if you have a 20-year term rider, if you say, "Ooh, I'm putting $10,000 a month into this, now I want to go to $20,000 because my business has grown or I'm more successful," like whatever, you may not qualify to get more insurance. You may not be able to do what you want. So you have to really be really clear on what your objectives are, what results you're going for, where you think your life, where you think your business, all these things are going, and think years ahead. I mean, years ahead. And sometimes the 90-10 is perfect and sometimes it's not, right? Like, and it
I
drives
so
me
I
nuts
so
when I
agree.
see,
Yeah.
it drives me crazy when I see people saying, this is the way to do it. Like 90-10 all the time, boom. And like, no, like, I'm sorry, but no.
Yeah, there's a movement in Canada. There's a group in Canada. You can do 90-10s in Canada.
Okay.
You can, and depending on kind of some like data points and basic illustration criteria,
Okay.
you can from 90-10. Then therefore you can kind of go up. You can go 80-20, 70-30. All the way up till you're kind of tilting the cash value and say the death benefit in the opposite direction. But a lot of the times that has to just do with age.
Yeah.
If you're a very elderly person, say you're 79 years old and you're looking for some kind of a permanent life insurance contract and you were rated, and then obviously you would see that those values would be a bit tilted. But it's still possible, and it's actually still something that would be of benefit to do. Again, in a lot of cases, but the 90-10 thing, I agree with you. It's not something that I recommend in a lot of cases. And people who are, say, new to the infinite banking concept or just getting into it, I think there's some inherent risk tied to it. And it takes a very sophisticated practitioner, and it takes a very sophisticated client, because the infinite banking concept, even though you can, in actuality in Canada, do it since 1847, it's relatively new. And it's new because the banks just really kind of didn't want you to know about it, right? The banks want you to pool your money there. They didn't know you could actually pool your money in an insurance company before you put it into said transactional bank account, right?
Yep.
So it takes a sophisticated client to really pull off a 90-10 type policy in Canada. And the fact of the matter is that there's a whole other kind of set of concerns around 90-10 policies in Canada, which are that some of the carriers that are offering it really struggle with the customer service side of it is a concern. You're talking to the employees and some of the employees at these companies don't really quite even understand what it is that they've created.
Yeah, no, there's no doubt. And I think like making sure you work with an agent, like if you're looking to buy a policy, work with an agent who is going to be there for you. Honestly, that's one of the reasons I stopped selling and I just talk about the importance of it, is because I'm super passionate about what this can do for people. But I also know my personality. I'm not the person who, I don't want to build a book of business of 500 to 1,000 clients where I'm having to meet with them annually and coach them and, all this stuff, because like for me, that's just not what gets me going. That's not what fires me up. I'd rather teach 1 million people about the concept and have them do it somewhere else. You know what I mean? And be a content creator and coach entrepreneurs to build their businesses and say, oh, by the way, what are you doing for your financial stuff? You should talk to some people. Because like otherwise, if I'm having to do 1,000 meetings a year with people for renewals, figuring out like what they're doing with their policy and it, just how's it going? What's the strategy? Where are we in the, on the timeline of what your objectives are, and like really looking at all that strategic stuff that goes into it, will make my head explode. The
world is better served. This continent is better served having you not licensed due to the fact that you can get on platforms like this and have a much more mass appeal. You can spend a more concerted amount of time fixing the problem and identifying solutions to the problem. And I watch your channel a lot. And what's brilliant about it is you attract a lot of advisors. And advisors are coming to you. And so this is really the ultimate solution to the problem, is empowering advisors, giving advisors the ability to show up different. And that's what I love about what it is that you're doing, is that you may be that domino or that precursor to getting the advisor to go out and do a deeper dive, to pick up a book like The And Asset, right? To pick up one of Nelson's books, to read something about Austrian economics, and to go out there and actually show up when they sit down with clients and show up and serve and show up with value. Not show value is one of two ways. Value goes add or it goes extract. There's no gray area to value. And if advisors are just showing up and they're just prescribing the strategies that have got Canadians to where they are today, or Americans to where they are today, which is basically broke. You know, we see all the stats in the news about 2 weeks ago about Canadians or Americans who are 20 years old being able to afford a home. Well, they can't afford a home. They won't be able to afford a home in major centers, major cities in this continent, due to the fact that they have no means to be able to kind of put together a down payment. And why is that? So if you're an advisor just saying, we'll do what we've done for the last 30 or 40 years, well, this is where it's going to get you. Here, we have enough evidence in history.
Well, yeah. I mean, the reality is I'm only assuming Canada is very similar to the US in this context, because most countries are, and especially Canada. What has led to success, I'm a big believer in asking why behind anything, right? And like when somebody goes, "Ooh, real estate's a great investment," or "stocks are a great investment," or whatever's a great investment, like I don't go, "Oh yeah, that's great," like I just want to do that. I go, "Well, why is it?" And then and a lot of times people don't look deep enough, and it's like I don't dispute that they're right. Like 401ks, listen, I don't love them right now. They would have been great in the 80s. When they were first created, 401ks were phenomenal. Why? Because we lived in a high tax rate environment. We had high interest rates. The ability to get returns were great. If you could defer income at a higher tax rate environment in 1984 or 85, where, you know, most people were in the 35% tax bracket, and you could pay now when you're hitting retirement at 20%. Yeah, that was the appeal. The problem is the environment that we live in changed, and people's mindset around what they're using for vehicles for retirement didn't. And the challenge is the United States government specifically, and the Canadian government with the RRSP, it's like they look at this and they go, we got all these people by the back of the head. And I'll just say that way. And so like, we got them exactly where we want them because they got all this money tied up. I did this video the other day. There's $35 trillion in the United States that are invested for retirement right now. That's a lot of money, right? 35 trillion. We're $28 trillion in debt. We got $35 trillion sitting in investment accounts for retirement. 26 trillion of that 35 is sitting in deferred accounts, qualified accounts where people are deferring taxes. So that is a pool that the government has complete legal right to be able to tax away from the American savers. That's disgusting. And it is not by accident that happens. So I don't know what the statistics are for Canada, but I bet per capita ratio, it's probably very similar, if not more skewed towards those, from what I've been hearing about how Canadians take part in their RRSPs.
Yeah, I mean, it's offside. I mean, our RSP contributions are actually in Canada are actually down, and that's because of traditionally speaking. I mean, generationally moving into millennials kind of started the trend, and then Gen Y has continued with the trend. And I mean, if you really think about why our RSP contributions are down, I mean, it has a lot to do with the fact that there's no disposable income to put it. So 46% of Canadians are $200 away or less from insolvency. They're paycheck to paycheck. Essentially, that's what it means. So if they're paycheck to paycheck, there's no part of their paycheck that can go into, whether they believe it or not, a registered vehicle for retirement savings.
Yeah.
And we have this thing in Canada called the TFSA, and a TFSA is actually a really fantastic vehicle, tax-free savings account. It's just that the Canadian government caps it pretty hard. So you have it's around $6,500 a year roughly that you can put into a TFSA. So $6,500 a year over year, I mean, isn't going to get you too far. I mean, if you started out when you were 20, say, on a TFSA, and you contributed $3,000 a year, this is off the top of my head, so my math might be kind of wrong, might be kind of right too. So if you were 20 and you invested into your 70, $3,000 a year at 6%, you might have around just under $1 million.
Yeah.
Say over that period of time. So you'd have to be a pretty savvy person to be able to do that. I'm not counting for inflation.
I was going to say calculation. $1 million, if you're 20, 70, 50 years from now, $1 million is going to look like probably $200,000 looks today.
Right.
Maybe $250,000.
So right. So think about that. So at 70, you got $1 million, say. So you maxed out your TFSA, or you didn't really max it out. You actually used it to about 50% capacity, about $3,000 a year. You have a ceiling of about $6,500 a year. And some years it goes up, some years it goes down in Canada, depending on how generous the government is. But if you think about it, and you actually your parents, say there was a lot of stewardship and your parents funded, and you're smiling because you know where I'm going with this, and your parents funded, say $100 or $200 a month into a child whole life policy, 15 days old or 2 weeks after you were born, your parents marched down to the life insurance company of their choice and they purchased a whole life, properly designed whole life insurance policy, an infinite banking policy on your life. When you were 20, they handed it over to you. Now you had the money, the cash value, a lot of it, to put into the, now what you would do at age 70, you'd have the TFSA for $1 million and for about $46,000 invested over that long period of time, you'd have another $1 million in the life insurance contract. Oh, and you'd have a death benefit for your grandchildren and your grandchildren's grandchildren.
I love it.
So really that's the solution to the problem. I mean, this generation, we're toast. We should just, we just have to be honest about it. So the only thing we can really do is just encourage our kids to go get life insurance, properly designed life insurance, and pay it forward a generation.
Well, what do they say? One of the 12 steps, when you go through sobriety is like acknowledging you have a problem, right? Like you can't fix the problem until you.
That's step number 1. Yeah. Okay. You can't get to step number 2 without recognizing that your life has become unmanageable.
Exactly, right? So step 1, acknowledge you got a problem, admit it.
Yeah.
And you have to identify that problem and to know how to fix it and solve it. And so, the children's stuff, like think about compound interest. What do you need for compounding interest to really work? You need consistency and time. Like, you know what I mean? Like that's it. If you take a kid at 2 weeks old, I think when they first qualify to get one of these like infinite banking type policies,
that's right.
Talk about doing $100 a month. And you start doing that and you just commit to that as a parent, there's no greater gift that you can give to your kid. You know what, dude, next week, let's get on and just talk about that, because
let's talk about
alone is something everybody needs. And that's the United States, that's Canada, that's across the board. Like it works the same way there, I think, right? Like, I mean,
it does. Yeah, it really does.
So from that perspective, like think about it for if you had 20 years, let's say 22 years of their life, because let's face it, kids are getting out of high school, they go to college, they're not starting their careers till 22 to 24, maybe 25 this day and age, after they take 7 years to get through college. And, so you're getting them ahead of the curve, allowing compounding to work on their behalf for 25 years. That's that's literally increasing their savings time horizon. If they start saving at 25, you're increasing it by 50%. If assuming they save till they're 75 in that scenario, like if they're if they follow the traditional way of saving till 65 and retiring, which is kind of like how things are modeled typically, like you're increasing their time horizon by like 65%, just by starting them young and allowing compounding to work for that. And if you've ever seen the compounding stuff is like, hey, do you want to get to $1 million? Well, you could start saving $300 a month at 20 years old, or start saving $1,000 a month at 30 years old, or start saving, $3,000 a month at 35. And like, you see the compounding in it. It really, it's that hockey stick effect where it's little by little by little by little, and it just starts to go up. Boom. And getting that done for your kids, there's nothing greater for a gift that you could give them. And Cole and I have talked about this. We'll talk about this more next week, because we got to cut this short here in a moment. But the ability to do that, if we could just get every kid set up like that, it would solve all the financial issues in this country. It would make it so the government no longer had the ability to manipulate people into entitlements, into programs, into, basically financial slavery, which is the world that we live in right now. And so if you align with that and resonate with that, let us know, make a heart, like this video. We'll do another video next week just on that topic, because there are some awesome tools that we have coming out that are going to be awesome. And yeah, man, I'm stoked to talk about that. That'll be fun.
Awesome. Yeah, it's going to be great.
That's cool.
Dear Canadian parents and grandparents, what is your relationship with compounded interest?
Yeah, I mean,
we're going to unpack it for you.
It's going to be fun. So yeah, man. Well, that's cool. So yeah, I do got to cut this short because I do have an appointment coming up here shortly, but I'm super excited about doing this with you, Cole. I think it's going to be extremely valuable. We're going to touch on a lot of Canadian stuff, but we're just talking about this stuff conceptually anyway. And I know you have like a really deep understanding about the US markets and the Canadian markets and just the philosophy and strategy and how it works all together. So really excited to kind of just do these videos with you. Let's do them weekly and let's just keep getting value out there. And, you know, if anybody is in Canada and they want to talk to Cole, you can just go down below. I'll put a link. You can reach out to Cole directly. I'm sure. Are you okay with that?
I'm okay with that. Yeah.
Okay. If I'll do a link and I'll get it set up so you can get, you know, on a quick phone call with him, just to kind of have a conversation about any questions that you might have about the stuff, or about the infinite banking concept, or whole life insurance as a whole, or if you're an entrepreneur and you're looking for strategic financial planning in regards to your business, he's the man to talk to in Canada in regards to that when you're looking at kind of bringing the infinite banking concept, or the and asset as we call it, into your life. So that's it, man. Anything else you want to kind of touch on before we go?
I appreciate you, man. I love all the work you're doing, and I'm excited to move forward and create some real value and change the world.
Rock and roll, man. Well, guys, I hope this helped. Have a blessed, inspirational day. We'll see you on the next video. Take care.